I'm going to show you how to triple your Ethereum holdings using other people's money. You might call this a Mike Saylor strategy, but not exactly what he does. But I'm going to show you how to use other people's money to multiply the Ethereum that you have. I'll also show you how to do it with other crypto assets. I'm Brian. You're watching this because you like coin analysis or some daily updates, or you're just a complete degenerate. I've held off on mentioning this before because some of you might implement it. I'm not telling you what to do. My disclaimer, I'm a big dumb animal. This is clearly informational purposes only. This is dangerous. It is risky. You could get liquidated and lose not quite everything, but pretty close. However, on the upside, you could actually make quite a bit. I use this strategy myself because, like I said, I'm a big dumb animal. Here's what you do. And I'm going to explain this fairly quickly, not to waste your time. And if you would, hit the like button because this is content that you may have gotten somewhere else, you may not. Let me show you what you can do here. We're going to start with the asset Ethereum. Now, if you go over to Aave, Aave is a borrowing and lending platform. Let me explain exactly what this method is. You're going to take your asset, you're going to supply it, you're going to take a loan against it for cash. You're going to take that loan, you're going to buy more of the asset. You're going to supply that. You're going to take another loan. You're going to buy more of the asset. You're going to supply that. And you're just going to keep repeating this. Each time, because of loan to value ratios, you'll be able to take a little less, a little less, and a little less, but you'll be able to compound what you have. I'll talk about the risks at the end. So here we are in the Aave dashboard. If you're not familiar, upper right-hand corner, you click, it'll connect your wallet. On the left-hand side, it's showing what you're supplying. It shows you the assets you can supply. It's looking into your wallet saying, what do you have that we're willing to take as collateral? And it shows you those here. On the right-hand side, it shows you what you've borrowed, if you've borrowed anything yet. And then below that, the various assets that you can borrow. Now, I'm not going to get into all the details, but I'm just going to say this for sake of this video. We are only going to take stable coins as a loan so that when we have to pay them back, we don't have to worry about the volatility of the assets. You take $1, you pay back $1. If you take a crypto, it could go up or down on you and you could end up owing more than you took out. So we're just going to use stable coins. Also, because if you notice here, some of this, it's got my numbers, so I'm going to blur it out. But under here, it says APY. Notice USDT and USDC are fairly low. Those do vary, and for various reasons. And I'll show you why. So here we are on the left-hand side. It says assets to supply. I'm going to walk you through an example of starting with 10 Ethereum. You could do this with 1, with 2, 5, 6.87 feet. It doesn't matter. All right. So let me read to you here. I'm going to throw it up on the screen. If you start, follow my math. If you start with 10 Ethereum, currently at around $1,500 of value for each of them. That's a total of $15,000. You put that, you essentially supply it into Aave. Aave will let you take a loan. Now, depending upon the assets that you have, the amount you can take as a loan can vary. I'm going to use round numbers here, 80%. So in other words, 80% of $15,000 is $12,000. They'll let you take a $12,000 loan. You go ahead and you say, I want to borrow USDT or USDC, and then it puts it into your wallet. Now, you just got $12,000 in your wallet, and it literally takes seconds. Let's just say a minute tops. This isn't like a bank. It's not going to take a week. It's not going to take 2 weeks. No one's asking you about your income or any of that other stuff. That's why debanking with crypto is awesome. Divide the 12,000 by 1,500, you end up with 8. So what you do is you go to your wallet and you buy 8 Ethereum because you have the $12,000 loan. Now you've converted that stablecoin into Ethereum. So now you have 18 Ethereum and you owe $12,000. Now we're implementing this method because we believe the market is going to go that way. If the market starts going that way, you're going to have a problem because you can start to be liquidated. But with liquidation, you have oversupplied. So we'll get to that at the end. Keep following my math. Now you have 18 Ethereum. So you bought that 8 Ethereum. It's in your wallet. It pops up here. It says, hey, you have 8 Ethereum you can supply. And you go, yeah, I'm a degenerate. I'm going to supply it. And now you've got 18 supplied. And it says, hey, look over here. You can take more money out. And you're like, yeah, what could possibly go wrong? And you take more money out. So here we've got 18 Ethereum at a value of $1,500 each at $27,000. So now it says you have $27,000 worth of Ethereum. Why don't you take another loan? And you're like, yeah, all right. Little devil on your shoulder. 80% of that is $21,600. You've already taken $12,000 loan, which is showing up here on the right-hand side. So you can get $21,600. You've already taken 12. You can get another $9,600. You take it. You put it in your wallet. You buy Ethereum at $1,500. You end up with 6.4. Now you might be thinking, but the Ethereum price goes up and down. Remember, these things happen within seconds. So the odds of the price changing all that much within a 1 to 2 minute period of time, by the time you're done with this process, pretty low. So now you bought another 6.4 Ethereum. And of course, Aave says, hey, I see stuff in your wallet. You want to supply it? And you're like, yeah, of course. What could go wrong? So you supply it. Now you have 24.4 Ethereum times that by 1,500. You have $36,600 worth of value. And Aave says, hey, you want a loan? You're like, yeah. So you take another loan. 80% of $36,600 is $29,280. You currently have an outstanding loan for $21,600, which leaves you $7,680. Divide that by the price of Ethereum of $1,500, you bought another 5.12. You know the process. You put it back in and you stake that. Now, let's look at what we have and where we're sitting at the moment. We are now at 29.52 Ethereum that we've supplied. So we went from 10 Ethereum to, let's just call it 30, 29.52, 30. So now we hold 30 Ethereum, but we have a loan of $29,280, let's say $30,000. There's 2 things that can happen here. Well, 3. The price could just stay where it is and it's just going to sit. Now you're going to accrue interest. On the interest, you don't have to pay any loan payments or any interest payments. The only time you have to pay is when the value of your assets start coming down and there's a liquidation clause. They want to make sure they always get paid back. So over time, the interest will accrue. But we're talking about 3 to 6% interest at the moment. Now that can vary and it can spike. However, if it stays the same, you're good. You're just going to start accruing interest. But that really doesn't help you because you're going a little more into debt for this asset. More likely than not, it's either going to go up or down. If it starts going down, you risk the chance of some of it being liquidated. However, you can always, with other capital, pay down the loan or buy and stake more Ethereum on the downside. If it starts going up, and that's why we're doing this, because we believe that 1,500 will become 2,000, 3,000 or more. So someone is putting capital, dollars, into Aave, and they're getting a rate of return. Let's call that not risky. You, me, whoever might be implementing this method, would then be taking their dollars and saying, you know what, thank you, I'll pay you interest. I'm going to put it in an asset that I think might skyrocket. So yeah, I might owe 3% or 5% on 30,000 over the course of a year. But I'm hoping this 1,500 Ethereum goes to 3,000. I just doubled the money. Okay, so if you just doubled your money, then if you took a loan for 30, you end up with 60. You pay the 30 back and you made a profit of 30,000. Okay, so you see how that works. Now, a couple things to note, which we already mentioned. If it goes down, you got to be careful of liquidation. Look over here, and we're just going to jump into these 2 different ones, USDT and USDC. Down here it says details. Let's look at USDT. So here are the details of Tether, USDT. It gives you supply information if you're supplying and the average rate and how it can move. It's giving you borrow information. Average rate is 4.1% over the course of a month. Notice that. We're going to click in. Let's see what it is over the course of a year because the rates can vary and I'll show you why. So notice here of the course of the last year, the rate average is 6.62. That's this dotted line. Sometimes below, sometimes above. Last summer, it was above. Last November, particularly December, it was above at 19%. So you would be paying 19% during this period of time. Of course, it's come back down. Now, why would it spike during that time? Well, if we scroll down here, you see their interest rate model. When you're along this flat curve, the interest rate stays fairly low, and then it starts to rocket if you get to this end here. Why? Well, you have people supplying money, and or assets, let's just say, in this case, dollars, and then people taking loans in dollars. Well, obviously, you can't take more loans than they've supplied. It always has to be less. If it's a little amount, if it's a smaller amount below what looks like about 92% or so, so in other words, not all the money's loaned out, then the interest rate stays at that average pretty low. But if more money is taken out for loans, then the interest rate starts to climb up because it gets a little riskier. Two reasons that might happen. You can see it happened in an up market. Well, if you believe the market is not all that interesting, you might take some of your money and put it in and just receive a rate of return. When the market starts to move, you might say, oh, I want to take that money back, and now I want to buy assets with it. Well, when you pull money out, the amount that's supplied goes down, and now the amount that borrows, the amount supplied, that delta is becoming smaller, and it might all of a sudden trigger this higher interest rate. On the other hand, for those that are borrowing, they might want to borrow more USD because the market's starting to move. So you just have to keep an eye and realize this can change. That's one of the downfalls, along with the fact that you could possibly be liquidated. Now, that was Ethereum. That's on the Aave network. These rates don't fluctuate all that bad because they have a significant amount of money. Look, the available liquidity is 1.5 billion worth of tether into Aave that can be taken. The reserve size at the moment, 3.3 billion. That's unbelievable. That's a huge amount. You can do this entire process with other assets, depending upon the network. So for example, Hedera, you would go to Bonzo Finance. You can put up Hedera, just like we were putting up Ethereum. You can take a loan in stablecoins. You can buy more Hedera. You can put up that Hedera. You can get more loans, and you can repeat this process. Look up here on the screen. That's my school community. It has a monthly fee. There's a link down below. But if you're interested in this kind of detail, I'm going to put up a video. I have multiple courses. This community does two things. It has courses to help teach you how to do things and explain crypto if you're new, intermediate, advanced, and then also creating a community of individuals like-minded who are investing in crypto, want to learn more about it, and want to share information so that we can all make money in crypto. Thank you for watching. I hope this was helpful. Do please check out that school community. Have a great day.